Hello, financial enthusiasts! Welcome back to our channel, where we reveal the secrets to financial success in building a solid foundation for a brighter future. Assume you're a new trader eager to master every aspect of generating money in the stock market. You want a single, all-inclusive reference that tells you all you need to know. You're in luck, since that's exactly what you've found. In our previous video titled How to Start Trading Stocks as a Complete Beginner, we laid the foundation for your trading journey. And now, we're back with part 2 of this series, ready to dive in deeper into the topics that matter most to you. No time to waste, let's jump right into it. Get ready for a wealth of knowledge and practical guidance as we continue to explore the world of stock trading from a complete beginner's perspective. This is the video series you've been searching for, and you're already here, ready to absorb the valuable information we're about to share. So, without further ado, let's continue our exploration of the stock market and equip you with the tools and insights you need to succeed. Get comfortable, grab a pen and paper, and let's continue this exciting journey together. To begin with, it is essential to familiarize ourselves with certain trading terminology that is commonly used among us traders. These are essentially specific terms related to trading that hold significance. They can be likened to a secret code or a special way of communication. If you are new to trading, it is crucial for you to understand the meanings of these terms, particularly if you plan on watching this series, as we will frequently use them. Let's start with the first term, long. To put it in a very simplified manner, being long on a stock means that you earn profits as the stock's price rises. For instance, if you purchase a stock at $10 and it eventually reaches $20, you have made a profit. It's quite straightforward. On the other hand, the complete opposite of being long is short. When you are shorting a stock, you earn profits as the stock's price decreases. Here's a simple explanation of how it works. Suppose the stock price is $10. You approach your broker and request to borrow 5 shares of that stock at $10 with a promise to return them later. The broker agrees, and you now have $50 worth of short shares. 5 by $10. Your goal is for the stock price to go down. If the price drops to, let's say, $5, you can buy 5 shares at that price, which would cost you $25. Consequently, you have acquired the 5 shares at a lower price than what you borrowed them for. After returning the shares to the broker as agreed, you can retain the remaining profit, which in this case would be $25. I hope that explanation makes sense. In summary, when you have a long position, you make money as the stock's price rises, whereas with a short position, you make money as the stock's price declines. Next, let's discuss bulls and bears. If you're new to trading, you may have heard traders use these terms and wondered why there are references to animals in the stock market. It's indeed peculiar, and I can't explain why, but it's part of the trading jargon. Essentially, if you're a bull, it means you believe that the market will experience an upward trend in the future, or you prefer taking long trades. So, you might often hear someone say, "There's good market news today, I'm bullish." On the other hand, if you're a bear, it means you anticipate the market to decline, or you prefer taking short trades. A simple way to remember this is that when a bull charges, its horns swing upwards, while when a bear attacks, its claws move downwards. Congratulations! You're already becoming a professional trader by familiarizing yourself with these terms. Moving on, let's delve into the concept of spread, and this is where things become quite interesting. In the world of trading, there are 2 key prices to consider: the bid and the ask. The bid and ask prices reflect the rates at which buyers and sellers are willing to trade a particular stock. The bid price represents the highest price a buyer is willing to pay, while the ask price indicates the lowest price a seller is willing to accept for the same stock. For instance, if a stock has a bid price of $10 and an ask price of $11, it means that a buyer is willing to pay up to $10 for the stock, while a seller is seeking at least $11 to sell it. The disparity between the bid and ask prices is referred to as the spread, which encompasses everything in between. Often, when observing professional traders during live streams, you may notice dynamic data displayed on their screens. This data, known as level 2 data, includes the moving numbers of bids and asks. On the left side of the screen, you'll see the bid prices, which represent the highest prices at which buyers are willing to purchase the stock, along with the corresponding quantity of shares they wish to buy. On the right side, you'll find the ask prices, indicating the lowest price at which sellers are offering the stock for sale. The range between these two sets of numbers constitutes the spread. While we're discussing this topic, let's touch upon different types of orders that can be used when buying or selling stocks. Let's discuss 4 main types of orders that are important to know: market, limit, stop, and stop loss. A market order is when you express your immediate desire to buy or sell a stock, regardless of the current ask price. You instruct your broker to execute the order at the current market price. The advantage of a market order is that it ensures you will be in the trade without delay. However, the downside is that you may end up paying a premium since you're buying the stock at the current ask price. Next is a limit order. With a limit order, you specify a particular price at which you want to buy or sell the stock. For instance, if a stock is currently priced at $50, you can place a buy limit order at $40. This means your broker will only execute the purchase once the price reaches or goes below $40. The benefit of a limit order is that you have the potential to acquire the stock at a lower price. However, the drawback is that there is a possibility of your order may not be filled if the price does not reach your specified limit. Moving on, let's discuss 2 more types of orders: stop orders and stop loss orders. A stop order functions in the opposite manner of a limit order. Specifically, a buy stop order is used when you want to enter a trade only if the stock price increases to a certain level. For instance, if a stock is consolidating within a range and the upper boundary of that range is at $50, you might decide to enter the trade only if the price breaks out of the range and reaches $55. In this case, you would create a buy stop order at $55. Once the price surpasses this range and reaches $55, your broker will execute the purchase of the stock. Lastly, the 4th and crucial order type is the stop loss order. Unlike the other 3 orders, which help you enter a trade, a stop loss order is designed to exit a trade. Let's say the price of the stock is currently at $50 and you are in the trade. However, you decide that if the price ever drops to $40, you no longer want to remain in the trade. To achieve this, you would set a stop loss order at $40. If the price reaches or goes below $40, your broker will automatically exit the trade on your behalf, helping to limit potential losses. To summarize, let's do a quick recap. A market order is when you want to buy or sell a stock immediately, regardless of the price. A limit order is used to enter a trade when the price reaches a specific level. On the other hand, a stop order is the opposite of a limit order, as it is used to enter a trade when the price rises to a certain level. Lastly, a stop loss order is used to exit a trade if the price falls to a predetermined stop loss level. It's important to note that while there are more complex order types in trading, these 4 orders are the fundamental ones you should be familiar with for now. We understand that these basics may seem a bit mundane, but they serve as the foundation for our series. Our aim is to gradually progress and cover more advanced topics as we move forward. By the time we reach the final video in this series, you will have gained significant knowledge and become proficient in trading. Thank you for joining us in this video, where we discussed how to start trading stocks as a complete beginner. We hope you found the information valuable and insightful. Remember, trading stocks can be an exciting and potentially rewarding journey, but it requires dedication, learning, and practice. It's essential to approach it with the right mindset and a commitment to continuous improvement. So, if you're ready to embark on this exciting journey of becoming a stock trader, hit that subscribe button and let's set a goal for this video to reach 1,000 likes. If we achieve this milestone, we will gladly upload episode 3, where we will dive into more advanced concepts and explore some actual trading setups. Thank you for watching, and we look forward to seeing you in the next video.